Okay, welcome to everyone. I'd like to thank everyone for joining. We have participants from all over the world today: India, Philippines, Nigeria, Zimbabwe, Macedonia, and beyond. So we'd like to thank all of our participants who made it to join us with us today. I'm going to just give a brief overview on how this webinar will be run, and then I'll introduce our facilitator. My name is Jessica Alfaro. I manage the membership services here at SBBN. We've muted all the voice lines going through to improve sound quality, but we do encourage you to submit your questions by typing them into the chat box on the GoToWebinar app on the right side of your screen. We will be asking for input from the audience at a few points in the webinar, and we look forward to hearing your thoughts at those times. So I'd like to now introduce our very experienced facilitator. Srinjoy Sen has a record for building and grooming markets from ground zero, launching a number of products and services across geographies and driving aggressive growth strategies. In his own words, what has helped him in his success is his ability to transcend functional barriers and exhibit cross-functional sensitivity. Srinjoy comes with rich experiences in consulting, software solution and services, with wide exposure to international markets, including Africa, Middle East, UK, Europe, and USA, in addition to India. Prior to working with NettPositive, he has been associated with Dun & Bradstreet, Tibco Software, Datamatics, Infrasoft Technologies, and Burla Technologies. Currently with NettPositive, an Equifax Group company, which is the second biggest credit bureau in the world. He brings an in-depth understanding of BFSI vertical and is also certified as a Basel II professional. He's an economics graduate with postgrad in management and systems from SIMRS in Bombay, India. And now we'll move over to Srinjoy to take you through the webinar.
Thank you, Jessica. Thank you for the introduction. Welcome, everyone, and thanks for taking time off your busy schedule to attend to the webinar. As Jessica already introduced me, my name is Srinjoy, and I'm from NettPositive. Now, coming to the agenda, in today's presentation, I'll be covering the importance of data for a bank and the need for analytics. While we talk of the analytics, we are also going to be driven by the benefits of it and cover the requirement of how analysis can be used in the credit lending, specifically in the SME sector. While we discuss the need for credit lending, how we can use the analytics in credit lending, we can also will be touching upon what are the rating processes and how the analysis is done. Last, we will discuss the MIS part of it, which is extremely important, which will cover business intelligence and regulatory reporting. We talk of data. Now, most countries across the world will say data is everywhere. My experience is that, okay, Asia rich in data, most Europe is rich in data, but somewhere Middle East, Africa, some banks has data issue. But if you have data or no data, what matters is where do the banks start. Most banks in today's world loves to keep track of data, and they would love to do it because at the end of the day, that's the source of their business. They actually can define their next level of business through data. So when we say that making decisions is certainly the most important task of a CEO to the level of line manager, and it is often a very difficult one, which I agree. Rule of thumbs, intuition, tradition, and simple financial analysis are often no longer sufficient for addressing such common decisions. In general, the forces of competition are imposing a need for more effective decision making at all levels inside the banks. Look at it this way. Bank always had a lot of data, and even today they collect a lot of data. Means I can give you an example in Middle East itself, one of the biggest banks. When we go talk to them on analytics, they're always telling us that we have huge amount of data. Don't worry about data, just do the analytics part. But when we get into that, what we realize is that they have not taken best use of the data. So what we land up seeing is that the issue is not collecting data. The issue is how good you have used those data. So 70% of the banks actually tell us that they have not been able to use the data to best of their ability. Now, services within the bank, like the services that you provide to SME customers, is among the top attraction for banking consumers, ranking above product and convenience, but overall satisfaction is not high. Very differentiating against competitor with targeted customer service, especially when SME is now becoming the most focused target market for the bank. Bank stands to gain more market share, both through expanding their SME customer base and deepening relationship with existing ones. Customer needs and priorities are bank's most important focus area. So yet, with the finite amount of resource to be deployed, bank needs to find ways to align services and save to make sure that they are able to cater to the SME customer. Data analytics. What does your bank keep track of, and how do you currently use analytics? If you have question or anything on these, you can ask. But if I have to talk about what data does to your bank, does your bank keep to track of, I would say, but that doesn't make it any easier for you or for the bank. The required investment, actually, if you go in reality, if you have a look, is measured both in money and management commitment. It can be large and it can be small. It doesn't matter. Today, if you look at it, once you talk about investment or measured by money and management commitment, CIOs stress the need to remake data architecture and application in totality. Everyone is looking for the power of the black box model. That's the magic word. Now, why? Because it crunches through the unstructured data in search of cause and effect relationship. That's CIO. But when you come to business managers, he scratches his head while insisting that they must know upfront the payoff from the spending and from the potential disruptive organization changes. No one wants to change, nor do we want it. But you have to make sure that you are able to take care of your data properly.
Great. Well, let's go ahead and pause here and see if any of our participants have any answers to this question. So, of the banks that are online now and are participating, can you let us know what type of data you're currently looking at and if you are actually using any analytics with that data? All right, well, some of our participants are using data for marketing purposes, so they're keeping track of the types of clients by industry that are using certain types of loans to try to build out some data to find new customers for those types of loans, so for marketing purposes. But it doesn't look like a lot of our participants are currently using analytics. Rather, they are keeping track of the data, but don't necessarily have strong tools for analytics in place at this time. Yeah, another participant says that they're using analytics for loans tracking. So that's another area. And also customer information data for credit checks as well. So it looks like it's pretty widespread.
See, for loan, the last question was what? The credit checks, right? So that's part of the process within the bank.
Correct.
I agree. Correct. But when you do take care of the CRM part of it, and when you actually take care of analytics, and I agree also, most banks today really don't know how to use analytics in its right form. Sometimes developing a scorecard does not mean that is analytics. Having said that, most often than not today we are actually using an Excel sheet-based analytical tool. Whichever way you look at it, I'm pretty sure in certain percentage or probably in certain continents, in certain places, you will have great software to be used to define your analytics. But for that you have to have those great data available. Now, does that make your job any easier? The required investment or all that, does that make it better? End of the day, what the answer lies is in the data. For you to make informed decisions, you need to have the right facts, and based on the facts, your knowledge about specifics will help you make sound decisions. As the graph depicts, knowledge is what we know well. Information is a communication of knowledge. data is known to be crude information and not knowledge by itself. So please remember that. The sequence from data to knowledge is from data to information, from information to facts, and finally from facts to knowledge. Data becomes information. Informed decision is what you need to take. And how will you take informed decision is when you have the facts defining your knowledge, so your brain is able to take those decisions. Information becomes facts, but when the data can support it, facts are what the data reveals, and therefore data becomes analytics and is a science of examining raw data with the purpose of drawing conclusions about that information. Data analytics is used in banks to allow organizations to make better business decisions, and in a way it is a science to verify and disapprove existing models and theories. The need to turn data collected about customers into useful information has become generally apparent. As a result, most banks today have developed models that do customer data analysis. In a way, it's kind of in the question that you said, that okay, you are doing certain part of it, but not all of it. So where is this data? Is this a single truth of, where does it lie? Means, is everyone using the same data? Or you are using the particular set of data sets which actually defines your department? So, you are working on a silo. You are kind of, an organization in itself within the bank. Why do we need analytics? Banks need smarter ways to manage the flow of money, and especially this has happened post-2008 when the financial crisis happened. Everyone needs to be smarter today, and banks especially. The roadability lies in better decision making by using analytics to align all the data within the bank and help make sure it is accurate, timely, in context, and available to all who need it. With banking analytics, your organization gains a complete and consistent view of all key profitability drivers, so you can actually manage risk effectively, track, monitor sales, margin, operational performance, region, product, demography, which is most importantly is customers' behavior. Dynamically, of course, has plans to achieve profitable growth. Help meet regulatory demands mainly, and this is regulatory demands mainly in the, defining credit analytics, because there are huge focus by regulators today to look at, portfolios. How good are you in kind of making sure your capital is actually going to the right people? Analytics can provide customer segmentation groupings within the SME segment. For example, at its simplest form, dividing customer into those most and least likely to repurchase a product. You do that? Means, of course, profitability analysis. Which customer leads to the most profit over time? Personalization, the ability to market to individual customers based on the data collected about them. Event monitoring. When a SME customer reaches a certain volume of usage of loan, what next? What do you do with them? Now to do that, you have to also look at what if scenario. How likely is a SME customer or a customer category that bought one product from your bank is likely to buy another similar one? And if so, what are you doing about it? Predictive modeling. For example, comparing various SME product development plans in terms of likely future success given the customer knowledge base, provided you have that knowledge base of the customer, the data available with you. The data collection and analysis are viewed as a continuing and iterative process and is ideally over time business decisions are refined earlier analysis and consequent decisions. Benefits of customer relationship analytics, which is called CRM analytics, are said to lead not only to better and more productive customer relation in terms of sales and services, but also to improvement in lowering cost and more competitive pricing. One of the major challenges, and this is like implicit in CRM analytics, is how to integrate the analytical software with your existing legacy system as well as with other new systems. The question I would ask now to all of you is, do you use any software for CRM?
And that would be a question actually that we have coming from our participants as well. So a question coming from our participants is there a need for specific software or specific tools for data analytics, and how do you suggest that our participants select and choose the software?
Okay, see, there are plenty of software available. If you're looking at base level CRM software, it should be able to integrate with your core banking. Because effectively when you do branch banking, you have the customer coming in front of you. It should be able to integrate with your core banking so that, on the tailor, on that place itself, your relationship managers are able to offer the products that best fits the profiling of that customer. So therefore, it actually will help you in that front if you are looking at the software part. There are plenty of software like, analytics is like SAS to Moody's, everyone has it. We also have it. NettPositive, we kind of very heavy on analytics. But the suggestion is that, you have to look at, see, what happens in CRM is that you have too much of time taken in implementation. So you have to make sure that the KPIs are defined rightly, your data sets are given much in advance, identified, defined, put in place, and then, go for implementation. So what happens, the time taken is much less and it is integrated very well with the rest of your application. So always look for a solution which is actually, is robust in nature, which can actually take care of information from different applications.
Thank you.
Okay, so let's go to the best practices. If I have to, and not surprisingly, the answer simply put is to develop a plan actually, to define best practices. That may sound obvious, but in our experience, the missing step for most banks is spending the time required to create a plan for how data, a simple plan, for how data, analytics, frontline tools, and people come together to create business value. The power of a plan is that it provides a common language, allowing senior executive technology professionals, different departments within the bank, line managers to discuss where the greatest return will come from. And more importantly, to select those 1 or 2 key bases to get started. Now, you may look at, there are plenty of them, like, we are talking about data privacy, master data management, critical data inventory, data integration, which is also very important. Critical data consists of those data elements that actually defines the business definition. Data integration, it covers the acquisition, composition, and enrichment of the data. Data profiling is just the examination of the data to collect statistics and characteristics of the structure of the available data. So I'll just touch upon a few of those so that, if you have any questions, you can ask me at the end of the session. So just to give you brief, like data quality, equally important, measures the fitment to intend to use, how to use it. It has to be measured for accuracy, completeness, conformity, consistency, duplication, and integrity. Metadata is important it is about the data itself. It captures the attributes of data. Master data is actually the single source of truth, which is actually authoritative and agreed upon source of data that is critical for business operation. Reference data is used to classify and categorize data. And of course, the privacy of data, which is actually to do with information privacy and protection laws and regulation. Now, benefit of data-driven analytics. Long-term customer value is fully related to brand engagement. Right? Now, how often and how extensively the SME customer interacts with the brand which your bank and the product is offered to. Growing amount of web and other channel data now make it possible to access how involved a customer is with the brand and estimate whether the brand sits in the SME customer's hierarchy. Now, you have to define that. This data actually summarized in new customer metrics is useful in identifying customer opportunities and risks and can be used to help shape marketing strategy. And it is very important. Analyzing brand engagement establishes baseline behavioral metrics, and that specifically examine how a SME customer's engagement activity correlates with key business measures such as sales, revenue, retention, profitability, and loyalty. Loyalty, which is again important for you because you need to get that customer back again to to do business with you. It also looks at engagement momentum, whether it's improved working condition, it is improving in terms of the relationship or worsening, to spot sell opportunities or determine if certain customer behavior needs to be stimulated all over again, because sometimes the customer just dies down even though they would be part of your database. Identifying customer potential. It is well established that typically a small percentage of SME customers is responsible actually for a disproportionate percentage of bank's revenue and profit, commonly referred to as Pareto's law, which is of course got to do with the 2080 rule. This concept has helped formulate how banks have marketed to their customers, investing in some and cutting spending in others. Customer potential, however, is determined by how much revenue or profit a SME customer can generate in their category. So it is involved looking at measures like share of wallet, expected lifetime value, etc. In the short run, share of wallet is pertinent because it quantifies how much opportunity currently exists with each customer. In the long run, bank needs to examine how a SME customer's value is likely to change over time. Customers that are high value now may not be high value in a few years, and vice versa. That's because SME customers frequently go through this fairly predictable life cycle where value builds, peaks, and of course then declines. There are well-defined, framework for building SME customer loyalty and value. The customer development framework is based on the principle that your current SME customers are the most cost-effective audience for which to acquire new sales and increase profit. The framework starts with analysis and is coupled with a marketing program development process to ensure that customer insight are turned into practical and actionable marketing activities. The customer development framework specifically addresses the creation of differentiated value proposition, recommends as active targeting and tailoring process, and establishes the key metrics and feedback system to access performance. Now, to boost customer loyalty and value, we also examine key behaviors and attitudes by analyzing retention rate, upgrade, downgrade, migration, some of it mentioned here, product cross-sell, propensity, customer community, etc. Advancing data-driven customer marketing. Now, this is where, some of the interesting thing comes. Our experience has shown that to be a successful customer marketer, you need the right foundational data, the right approach to experimentation and learning, and the right refinement procedure to ensure continuous SMA product program improvement. We have incorporated this insight into some, a phase 3 kind of thing you can call it. Access data assets that are available. Examine the current product marketing programs and evaluate the process and procedure for making marketing decisions and getting new initiatives into markets. Phase 2, review current test and learn procedure and make recommendations regarding how to capture more marketing performance data more quickly using experimental test designs and other analytical techniques. Phase 3 ensures that the new learning is used quickly and effectively to refine existing marketing, programs, so on and so forth. Channel optimization again is, continues to proliferate and attract more SME customers. Business need to know how to optimize their use. To support this, we use an assortment of analytics to help banks to determine how much to spend in each channel, how to manage resources related with each channel, how to interact with SME customers when they are operating within a particular channel. While proper metrics are a key aspect of channel management, we also incorporate other quantitative tools like LTV modeling, product propensity scoring, traffic and call forecasting, offer optimization in the sales and marketing process to maximize channel effectiveness. Within automating marketing decisions, you have audience selection, which actually, defines large-scale business gains can be achieved. Now, how? It runs a customer record through one or more algorithm with the intent to identify individual customers who are eligible for a specified marketing app. Product cross-sell assignment. Scores customer based on their propensity for an array of product and is used to guide marketing communication, various channel interaction or solicitation. Event trigger marketing automates marketing communication based on relevant customer data that is captured in a marketing information database, or it could happen in a real-time system. Offers of optimization using statistical model to find the best offer to extend to a customer based on the program goals and assorted client supply constraints. So, marketing decisions and analytics, what software or manual reports is your bank using to define and determining marketing decisions? Okay, so let's look at credit and analytics. So, assessment of loan application. The question that is often asked and which should be relevant to you is, do you assessing loans manually? And if you're doing so, means you're capturing some data. Where is those data being captured internal to your organization in the bank? It's just a paperwork. It's not digitized. It's not available. And if it is available, how it is then from a manual point taken to the automated line. Now remember one thing, credit analysis is a job that comes with a lot of responsibility. Generally, while trying to do credit analysis, it is huge responsibility to assess a loan applicant's credit worthiness. Obligors credit analysis is a fundamental part of the credit risk activity of modern banks and financial institutions. However, it does not stop there. Any entity entering into a transaction with another entity which involves taking credit or other risks must ensure that proper analysis is carried out on that entity or obligor. It goes without saying that this should happen in advance before a said risk is uncovered. It is not just credit risk. Due diligence requirements means that we need to know exactly who we are dealing with, the legal and regulatory status, etc. For disbursement of credit to SME sector, we need to know what is important and what what are the responsibilities of the bank? When a bank lends, it should be responsible for gathering and analyzing financial data for clients, which should include repaying capability or using historical data, which could help in capturing, earning, and saving information and activity, which could provide an insight reference to the behavior of the client's spending habits. After the data is gathered, the bank evaluates data and recommends the course of action for the SME customer. But please remember, credit analysis is not limited to the client who have defaulted or going to default in their names. Credit analysis is equally important for potential SME customers seeking new credit or customers who are being considered for credit line extension. Quality of data, again, we've spoken about in length, and improving, the business without exposing themselves beyond the threshold defined internally by the bank. You should, use that data in the right way of capturing data. So that's where the expert model, etc. comes through. Coming to knowledge of industry, the purpose is to analyze and to understand the condition in which the business operates and the changes, which could be cyclical, competitive, and technological. And that is likely to happen. That happens. So most industry exhibits some degree of cyclical volatility, and some industries are exposed to seasonal variance. Such volatility affects the operating performance and financial condition of the company. Technology changes and new competitors or substitute products can also affect performance. So, it's always good to keep that in mind. So there are two aspects. So one is the financial aspect, the other one is the non-financial aspect. So both sides is relevant in terms of when you make a decision as far as lending to SMEs. Now, better data, better risk management. Look at the central bank. The regulators, when we started way back, in the 80s, they started to play more, laid back attitude. They didn't have much to do except for taking care of the licensing. But today they are now started to play a more proactive role. They have concerns about the magnitude of credit risk exposure taken by the bank in all areas like corporate, SME, and retail, especially when it comes to unsecured loans and the risk of systemic failure. As a result, they began to coordinate more internationally to raise bank capital requirements, to encourage standardized international accounting practice, and to focus on ways to reduce risk in the market, which of course then again led to Basel I and then to Basel II, and now to a great extent people talk of Basel III, but which I don't agree to be a Basel III because it is a reaction to post-2008 financial meltdown in US and Europe. So it's just an addendum to Basel II. Some banks have head start in this area, having long been required to assign a credit quality rating to every asset, which we talk of, asset quality. Now, they benefited from the existence of an independent department, which is credit review, who does the checking. They do the checking of the work of the credit risk department to ensure that assets were properly and correctly rated. For an asset rated substandard, a bank would need to make provision equivalent to 15 to 20% of exposure, or that would exposure a commitment, you can call it. Doubtful required would be 50% and so on and so forth. If you look at the rating part of under the Basel II, banks which could demonstrate competent counterparty modeling and analytical skill in-house and qualify the internal rating-based approach, which we know as IRB, has of course benefited from reduced capital requirement. Other than what the central bank has said, the central bank may tell you keep 8%, 10%, but if you have the IRB rating in place and if you have the right risk model and the risk-based internal risk-based approach, you can actually go back to the central bank saying that we, according to us, this is how much of capital we should set aside, and which is an accepted practice. Following the credit crunch, the bank experienced severe problem, which we all know, went into liquidation. Some of them got bailed out, etc. Now, what happened? So the external rating agencies model have clearly been wrong in their assessment. In fact, there is a UK governmental report in which they say how this exposure and its magnitude came about, revealed that some 51% of the local authorities relied exclusively on the advice of the external rating agency. In some cases, deposit limits were justified on the basis of the obligor's total assets. However, they approached it, there was no independent fundamental credit risk assessment done internally, in which internal rating-based approach was used, which is the IRB, which is a bit advanced, but if they had done it, it wouldn't have come to that level. So for the record, rating agencies cannot again be blamed for all the problems of the financial institution. It's a mixed bag of systemic failure, both in the internal credit risk process of bank and the external factors like rating agencies. In the end, as such and as much assistance as possible is needed in risk analysis, risk management and risk reduction, and the better quality of information and data we can offer, the better will be the decision we will be able to make. However, the final weapon is our judgment, our professional assessment as applied to the issue facing us day to day. For example, can the accounting standard on a given country be relied on? Are the financial statement of the entity there accurate? So there are questions. So I go to a country in Africa where you can use one document in three types of loan, and those documents authenticity is always a question mark. You never know what happens. Credit risk is the primary financial risk in the banking system and exists in virtually all income producing activities. How a bank selects and manages its credit risk is critically important to its performance over time. Indeed, capital depletion through loan losses has been the proximate cause of most institutional failures in the past. Identifying and rating credit risk is an essential first step in managing risk management effectively. So, function of credit risk rating processes are credit approval and underwriting, which would actually take care of your risk rating. Should be used to undermine or influence who is authorized to approve a credit and how much credit will be extended or held and the structure of the credit facility, which means collateral, repayment terms, guarantor, etc. Loan pricing, which is risk rating, should guide the price setting. The price for taking credit risk must be sufficient to compensate for the risk to earning and capital. Incorrect pricing could lead to risk return imbalances, cost businesses, and adverse selection. Relationship management and credit administration. A credit risk rating should determine how the relationship is administered. Higher risk credit should be reviewed and analyzed more frequently, and higher risk borrowers normally should be contacted more frequently. Problem and marginal relationships generally require intensive supervision by management and problem loan. So it has to be worked out by the specialist. Now, capital adequacy, which is extremely important. So allowance for loan and lease losses, or capital, whichever way you call it, is actually every credit's inherent loss should be factored into its assigned risk rating with an allowance provided either individually or on a pool basis. Capital adequacy must be directly correlated with the level of risk indicated by risk rating. Ratings are also useful in determining the appropriate amount of capital to absorb extraordinary unexpected credit loss. Management, and this is like MIS and reports. So coming to that means if you look at the management information report, risk rating report that aggregate and stratify risk and describe risk trends within the portfolio are critical to credit risk management and strategic decision making, which is key to your, defining how good it would be. All credit exposure should be rated. Where individual credit risk system or not assigned, that is small denomination performing loan bank should assign the portfolio of such exposure, composite credit, repayment, etc. That also needs to be seen. The risk rating system should assign an adequate number of ratings to ensure that risk among past credit, that is those that are not adversely rated, are adequately differentiated. In most credit rating systems require several pathways, and ultimately risk rating must be accurately and timely done. Now, when you look at development of credit risk rating processes, many banks are developing most robust internal risk rating processes in order to increase the precision and effectiveness of credit risk measurement and management. This trend will continue as banks implement advanced portfolio risk management practice and improve their process for measuring and allocating economic capital to credit risk. Further expand risk rating process requirements are anticipated for banks that assign regulatory capital for credit risk in accordance with the Basel Committee, which is part of your Basel II proposed internal rating-based approach to capital. More and more banks are doing it. More and more are using two rating systems, linking risk rating processes to measurable outcomes for default, etc. Linking internal and external ratings. Again, independent rating agencies we spoke about provided independent rating models and analysis keep the investment public informed. Banks are starting to map these internal ratings to public ratings. Now they are much more careful. Scorecard modeling, if you look at, which is again very important. You can have a statistical method to define quantitative factors according to the model's vendor and research indicator of default. Or if you don't have data, you can start with expert model attempts, duplicate and credit analyst decision making, and move to hybrid system, and then move up to the level of defining in your application the statistical models. Rating process and controls, of course, has to take care of from starting from the board of directors to senior management, staffing, review. And these are all part of what the Basel II framework has defined, and that's how the whole review, the risk process controls should be in place, because otherwise it would won't fly. So let me come to now the credit analysis part, the financial statement analysis. See, there is no substitute for rigorous analysis of a borrower's financial statement. The balance sheet, income statement, source and use of funds statement, financial projections, providing essential information about the borrower's initial and ongoing repayment capacity, quantitative analysis of revenues, profit margins, income and cash flow, leverage, liquidity and capitalization should be sufficiently detailed to identify trends and anomalies that may affect the borrower's performance. The balance sheet deserves as much attention as the income statement. Balance sheet can provide an early warning of any problem. If you look at the example, if asset degrade on a relative level of asset liability change and asset and liability changes, commercial borrower generates their revenue, income and liquidity from their assets. So examiner should analyze the composition of these accounts and how their proportion changes. Capitalization and liquidity also warrant careful analysis because they imply a borrower's ability to withstand an economic slowdown on unplanned events. So you have the cash flow, which again everyone is well aware of, so I won't go into detail, but I'll touch upon ratio analysis and benchmark. So on the financial ratio provide vital information about balance sheet and income statement proportion. So debt to equity, income to revenue and all those areas. Compare a borrower's financial ratio with prior period and the industry or peer group norms can identify potential risks. Whenever a ratio deviates significantly from that of its peers, the examiner should conduct further analysis to define the root cause, which is true. So analysis of projection, while current and historical information is necessary to establish a borrower's condition and financial track record, projection estimate expected performance also. So examiner should analyze how projections vary from historical performance and assess whether the borrower is likely to achieve them. Projections should be analyzed under multiple scenarios. So downside, break-even, best case, most likely case, etc. and stress test period. Borrowers then quickly or repeatedly fall short of their projections, lack credibility. Examiner's conclusion that a borrower will not be able to perform at projected level should be factored into the loan. So other payment sources again means, everyone is well aware of what's there for, evergreen loans, etc., which is a loan whose repayment continually relies on refinancing. So whose borrower fails to achieve successful recapitalization also requires scrutiny. So coming to MIS, to look at MIS, we have to go back to, where we started from, the data collection, processing of data, single source of truth, and then dissemination of the data. So because that will actually, in effect, will define how good your information management system works. Because if you don't have data, that's it, we don't have anything. The banking industry, by far, if you look at the BI side of it, is becoming increasingly competitive and facing ever-changing regulatory requirements. So it's making more and more challenging for banks to keep up with the changes and, of course, with the competition. With a vast range of SME customers and customer needs, ongoing regulatory changes, and increasing consolidation, banking enterprises need information management that will allow them to make smart decisions. Bank needs to use all the tools at their disposal to change the many industry challenges and ensure their own financial stability to engage in this. So with such far-reaching scope of service and concern in the banking industry, banks handle immense amount of information. And so true, it's hard to keep track of important information and even to know which information is valuable, and banking enterprises need the tool to take advantage of the myriad information at their disposal. This information technology available today allows these companies to make better business decisions and to better target performance goals. BI offers the banking industry the report on analyze and monitor the vast corporate data through a business intelligence architecture that helps banks reduce costs, increase revenue, and maximize the value of information. Let's look at the challenges in the regulatory reporting. So I probably had a question in mind, but we'll just throw and work out the regulatory part. My question to everyone has been, what particular challenges do you face with respect to completing banks' regulatory report? And I won't be surprised if I hear that also that within the bank, how many people actually work in the MIS department? Because most often than not, it is always the MIS department which is actually which is not resourceful enough to provide for the reports that is required internal to the bank as well as by the regulatory authorities. So 80% of the bank today, within the system limitation are the most common data challenge. Data integrity and resource limitation are the next most sought-seeked issues. So resource limitation is the additional analysis of the challenges to bank when completing reports compared with the level of automation revealed that respondents with partially automated regulatory reporting process were more likely to have reporting errors. Bank needs to enhance their flexibility and effectiveness to be able to face with regulators' application. Going forward, banking institutions need to be carefully considering enhanced regulatory accountability capabilities, so on and so forth, the 4 points that I have given here. So with this, I kind of finish, but at the end I would like to also mention that automation, always along with enhancement with business processes and the overall control environment, will help bank institution keep pace with the changes at the broader regulatory environment, which can continues to evolve. So thank you everyone. Thank you. Jessica, it's over to you.
Okay, thank you very much. We do have some questions, but first I wanted to get back to the responses. So in terms of software or manual reports that the banks are using, it looks like both. It looks like some banks are using manual reports at this time, and some are using software, more automated reports. So one of our banks mentioned that they're using a highly modified Excel file for data, which includes loan accessing reports, profitability reports. Another institution is using customer feedback registers. So essentially getting feedback from those customers to make some further marketing decisions. And another bank isn't using any at this time, so hopefully they've found some good tips within this webinar to help them build that out.
Jessica, this is a very interesting thing that I've also faced many a time, most often than not, that people are doing a lot of reporting on a refined Excel sheet, so to speak. Now, what happens is that in an Excel sheet, the chances of error, human error, is extremely high. First. Secondly, it takes a hell lot. It's like, you are recreating data every time you're creating an Excel sheet. So you are actually going on mirroring data continuously, and to store it, it will actually cost you heavy. So rather than spending money, time, effort into defining Excel sheet-based reporting, one should actually look at automating it. And while you are automating your reporting, what you are actually also going to do is going to put all your data under one centralized system, so that whoever wants to see whatever can be achieved, and of course based on the hierarchy within the bank. So those read-write policies also there. So whoever needs to see what they get to see, and based on which they can actually make very a good amount of decision which will be informed, and those will be right. And more importantly, Jessica, I just want to finish it by saying, remember, today most of the banks actually make decisions which is reactive. None of them make decisions which is proactive. So it's either the central bank which is actually defining the framework based on which the banks are reactive, or on the business decisions, bank says, okay, fine, it reacts to situation. It is never making decisions based on this, data which is available to them, and saying that, okay, fine, next 5 years down the line is what you want to achieve, and therefore our decisions are based on the data, and these are the steps we are going to take.
Maybe you could talk a little bit more about how some of our banks can move from having these modified Excel sheets or these manual reports and into actually automating some of these. Is it that they need to buy software to do this? Is it that their MIS needs to build something out? Walk us through how an institution can automate these reports.
All right. See, we've come across in many countries, and this is not just in Middle East or in Africa. Many countries, big and the best of the banks, they are still using Excel sheets. And what we have actually transformed them to do is, actually redefine them. Okay, first you have to actually define your data. So it's not just you defining, but your IT department. So what happens whenever, let's say, SME credit portfolio guys want to get some data, they will ask the IT guys to bring it to them, or send it to us. So when it actually, by the time you say that and from the time it is executed, you got probably a week or 10 days already gone. By the time the data comes in and you actually, slice and dice that data to actually make some sense out of it, you're talking about another 3-4 days. So effectively, you could have made a report out of probably within few hours, probably 2 hours, right? You landed up on a manual basis doing the same work for 14 days. And therefore, your decision is actually based, 14 days later. The scenario might have changed by then. Things would have, there could have been some event that was taking place internal to your country, or within the financial sector, or within the, the data available to you, because, industry-wise or specific client, things could change, their behavior. 14 days is a huge time. So effectively, you have lost an opportunity to define yourself and take that, first mover advantage. So what we actually do for most banks is that we actually first define the data, and that becomes a single source of truth for everyone. So it just does not matter whether the SME wants the data, or the retail guys needs the data, or the corporate guy needs the data. End of the day, whatever data they need, they just need to fetch it, they need to send a query, and that whole data, gets downloaded into the system. And from the system, the application picks up those data sets, brings it, makes statistical, we create those models, we have those KPIs. So we build those, and it happens automatically, no manual intervention. And thereafter, some of the reports go to the CEO level, because there are some reports which are strategic in nature, some reports which are operational in nature, and some reports which, different line manager needs to have a look. So everything is sent on their email automatically. So either you can watch that through your email, or you can actually log in and see your screen. So it kind of effectively fully takes the human side out of it, and it can happen within few hours.
Great. And we have another question that's come in from one of our partners. And what software would you recommend for a small bank for MIS purposes?
It's a very good question. It's a very good question. So I'm not sure if you what you mean by being a small bank, but if I look at the MIS part, I would suggest there are some so there are a few. But let me tell you one thing: being a small bank does not mean that tomorrow you will still stay the small, right? You will have to grow. Now, if you look at the investment of next 4 to 5 years, I would say look at a medium-sized software which should not cost you heavy in terms of dollar terms, but can actually take care of your BI, means the MIS, BI, which actually will also improve your analytics, and end of the day, it kind of serves your purpose. But before that, being a small bank, I can also probably ask you a question. I hope you have your data sets ready, or if you need help on that, then you're talking a different language, because then you have to start from defining your data, capturing them, bringing them up to the MIS. Having just software will not solve your problem.
One more quick question. Maybe you can talk about what data that banks should be collecting that are really the most helpful for them. Maybe something that when NettPositive goes into work with a bank, you find that they're often not collecting that data. What are some typical data points that banks should always be collecting?
All right, thanks, Jessica. Okay, if I look at generally, not to be very specific, generally, let me put it this way, that the data sets that should be collected is name, age, nationality, address, gender, place of residence. So I would say what's there in your core banking should be your, the first level of data sets that you're looking at. So today, anyway, core banking is available to everyone, whether you're small, medium size, or large bank. Core bank means you are automated on the software on the core bank side. So what's there in core banking, those data sets are automatically taken. Now, different departments, if today we are talking about, SME, so let's focus on that. For SME segment, you need the LOS, which is the loan origination system. So you need to pick up the data sets from there. So it will be both. For SME, you will have the financial data as well as the non-financial data. So non-financial data, you can also look at the number of years in business, type of industry, and where it is located, number of employees, retention of, means, how many employees is retained over a period of time. So this thing will actually give you how smooth or how good that organization is, and how your lending should happen. So I hope I've answered that question.
Great, thank you. We definitely have more questions coming in about how to move reports from being manual to automating them from several of our attendees. So maybe Srinjoy, you can send over more information about that. And I also encourage our participants to send questions to David or I, and we can make sure we get those questions answered for you from Srinjoy. One final question that we have is, what factors do you think are important for consideration in developing a dynamic internal credit risk rating model?
This is scorecard driven. So first you have to have a risk policy in place. So your credit risk policy should be in line with this strategy, and therefore you should define your framework based on that. Now when you define the framework, you need to have scorecards for different industry, different, doing permutation, combination, the statistical model. If you have the data. If you don't have the data, then you start with expert model. You start with the expert model over 6-7 months, work on it, and then move to hybrid. So by then you are kind of developing the data. Now remember, for a dynamic credit risk scorecard, or what you should do is to align your policy procedure in line with the bank's strategy. If you don't have that, it will fall apart. Most banks today, if you look at in US, everything, their strategy was different from what the policy said. If you look, the central bank policy was very strict. They kind of defined how you should, lend. But the strategy of the banks up there on the top was to make more money. So there was times when things were ignored. So remember, to make it the most dynamic, you have to have your policy procedure in place in terms in aligning with your strategy, and that itself will actually define your scorecard modeling, because the parameters that you will put in the scorecard modeling will actually be based on the data sets that you have captured today, or have historical sets of data from where it can be pulled. So that's the key.
All right. Thank you to all of our participants. We appreciate you going a little bit over, but I wanted to get in all of those questions. So if you do have any final questions, please feel free to email David or I at SBBN. And also you can post questions on our online forum as well, and we can respond to them there. So thank you again, and this will be the end of our webinar. We hope you will join us next month as well.
Thank you, Jessica. Thank you, everyone.
Okay, welcome to everyone. I'd like to thank everyone for joining. We have participants from all over the world today: India, Philippines, Nigeria, Zimbabwe, Macedonia, and beyond. So we'd like to thank all of our participants who made it to join us with us